afternoon, folks. Welcome to the Liberty Call. It is Thursday, August 4th, 2022. I hope everybody is out there having a fantastic day. It's a beautiful day here in Colorado. Had a little bit of some storms yesterday, but not too much rain, but just a lot of clouds and wind and all that good stuff we get here out in the on the Front Range. But today is beautiful. It's 83 degrees, and like I mentioned earlier in the week, we're getting close to the end of 80-degree weather. I think we have maybe another week or two. And then, after that, it's nothing but 70s and 50s and 40s at night, which, if you live a little closer to the south or down in Houston where most of my friends and family live, it's pretty hot down there from what I understand. Talked to a buddy of mine yesterday who was telling me how scorching it was. So anyways, speaking of scorching, the stock market definitely has been kind of fizzled today after such a huge rally back yesterday, after such a terrible day the day before. Again, the volatility is to be expected. I think people just aren't sure which way things are headed. Those in my position are probably a little more aware that things are headed more in a downward trend, still in the long term. Whether or not we're breaking the downtrend with this current small uptrend, I don't know. It's hard to say. But until we get some more clarification there, and we'll cover that tomorrow on the weekly wrap up as far as what the longer term market trends look like and the like. So anyways, well, let's go ahead and let me start out. If it's your first time watching, I know I'm 2 minutes in already. Give me a big old like, a big old thumbs up, a like, a share, a subscribe, all that good stuff. I would greatly appreciate it. I know there's people out there who want some help with their, with their finances, with their investments, what they're planning for the future. And, I'm here for you. If you need some help, just let me know. All right, let's go ahead and look and see how the indexes did today. This always pops open. The Dow Jones finished down 0.26% at 32,726. The S&P 500 was flat. It finished down 0.09 at 4151. NASDAQ was up 0.41%, closed at 12,720. Small caps were down 0.42%. The VIX, kind of a little shocking that it was down 2.32%, being that the S&P 500 was basically flat or in the red most of the day. Let's move a little further down, and the VIX is currently sitting at 2144 for those who are just listening and not watching the video. In Canada, they were up 0.16. Brazil was up 1.99%. Pretty good day for them. Mexico was down 0.16. Jumping across the Atlantic, Germany up 0.55. UK flat, up 0.03. France up 0.64, the Euro Stoxx up 0.59, Netherlands down 0.4, Spain up 0.23, Italy up 0.31, Switzerland up 0.21, Portugal up 0.1%. Moving further east, in Russia, both of their indexes were down. The MOX was down 0.35 and the RTSI down 0.11. Moving over to the Asian markets, Japan was up 0.69. Australia came in flat, finished down 0.01. New Zealand up 0.31. Headed over to China, the Shanghai was up 0.8. The SESE component up 0.69. The China A50 up 1.12. The DJ Shanghai up 0.81. And the Hang Seng up 2.06. Wow, that's a big jump there. And the Taiwan weighted came in down 0.51%. So, kind of a mixed day. It looks like the Asian and European markets fared a lot better than those of us here domestically here in the U.S. So is what it is, but I wouldn't get too worried about it. This downward trend will at some point break, but I first think that inflation is probably going to need to get under control first before we see any real improvement in the equity markets long term. All right, let's read through today's market recap. S&P 500 struggles for direction ahead of jobs report. Let's see here. The S&P 500 flirted between gains and losses Thursday as investors digested data pointing to a slowdown in the labor market just a day ahead of a crucial monthly jobs report that will offer clues on the health of the economy. The Department of Labor reported Thursday that 260,000 people filed for unemployment insurance in the week that ended July 30th, up 6,000 from the prior week, but in line with economists' forecasts. And, if you watch my Friday shows, I always cover the unemployment numbers. And, they have been slightly creeping up over the last 4 to 6 weeks. They had been I think we had bottomed out around 175,000 per week for a short stretch in, the late spring, early summer. But we've since then have crept back up into the mid 200,000s. So again, not anything to panic over, but I just think it's a reshuffling of the job market. Let's see here. The data came ahead of Friday's jobs report that will offer clues on the health of the economy. Following recent data showing the U.S. economy declined for a second straight quarter, economists expect that the economy generated about 250,000 jobs in July compared with 372,000 the month prior. The jobs report will also serve as a read-through on the Federal Reserve's likely path of action on monetary policy, as the central bank has highlighted the strength of the labor market as evidence that the economy remains robust and is able to withstand further rate hikes. Energy was the biggest drag on the broader market, down more than 2% as U.S. oil prices fell below $90 a barrel, the first time since Russia invaded Ukraine. Marathon Oil, Occidental Petroleum, and APA Corporation were among the biggest decliners in the sector, with the latter down more than 8%. Technology, however, cut losses, keeping downside in the broader market in check as big tech traded mostly higher, as evidenced by the NASDAQ. Elsewhere in tech, Alibaba gained more than 5% after reporting better than expected quarterly results, despite the lockdowns in China holding back growth. Consumer discretionary stocks are also supported by a jump in Amazon and Tesla as investors look ahead to the latter shareholder meeting today. At the meeting, shareholders are expected to back the electric vehicle makers' 3-for-1 stock split. MGM Resorts, meanwhile, jumped more than 3% after reporting quarterly earnings that missed estimates, but revenue topped expectations after more than doubling in the second quarter. Bookings Holdings, however, fell 2% after reporting mixed quarterly results as earnings beat, but revenue fell short of expectations, sending its shares more than 2% lower. Home builders were also in the ascendancy, lifting consumer stocks after data showing mortgage rates fell below 5% to their lowest levels since April as investors price in a less hawkish Federal Reserve. That could be a mistake. I think the Fed's going to continue to raise rates because, as I see it, inflation really isn't slowing from the things I'm looking at. D.R. Horton, Lennar, and Pulte Group were up more than 3%. In other news, Coinbase jumped more than 17% after the cryptocurrency exchange inked a partnership with BlackRock to allow the latter's institutional clients to invest in Bitcoin. So, some good news still. Lots of good earnings and all the like, and oil prices are down a smidge, not a lot, but a smidge. So that should help a little bit. More on oil. Oil drops with the dollar on recession fears. Wall Street wobbles. Crude oil sank on with Treasury yields and the dollar on Thursday as recession worries intensified following the Bank of England's warning of a drawn-out downturn, which sent sterling tumbling versus the euro. Wall Street stocks searched for direction a day after rallying, with a key U.S. job report looming on Friday. The two-year Treasury yield eased 5.1 basis points to 30.057, while the 10-year yield slipped 4.7 basis points to 2.7%. The gap between them went as wide as a negative 39.2 basis points earlier in the day, the deepest inversion since 2000. An inverted yield curve is often viewed as portending a recession. Well, an inverted yield curve is an excellent way to forecast for future downturns in stock markets, recessions, and all those sorts of things. So we've had a couple over the last few years. The yield curve was inverted in the fall of 2019. My guess at the time was that sometime in early 2020, we would go through some sort of a downturn. We did, but COVID mysteriously was there to give a perfect excuse to print a lot of money, which papered over all the big problems. And, now we're having to deal with those same issues today. Let's see here. Crude oil prices dropped to levels last seen before Russia's February invasion of Ukraine, with Brent off more than 3% to $93.81 a barrel and WTI down 2.7% at $88.21. Traders fretted that any recession could torpedo energy demand, while an unexpected surge in U.S. crude inventories also weighed on prices, which had surged to over $120 a barrel this year. Cleveland Federal Reserve President Loretta Meester said on Thursday that the economy is not currently in a recession, but the risks of one have risen, while reiterating the central bank's resolve to continue with aggressive tightening until there is a compelling evidence to let up in inflation, or of a let up in inflation. The monthly U.S. non-farm payroll report will be closely watched on Friday for clues on whether the tight labor market will continue to push up wages. Data early Thursday showed a tick up in jobless claims. Quote, expectations that we're headed for a recession are clear, and the clear signal is coming from the Treasury market, said Edward Moya, senior market analyst at Owanda in New York. Quote, things are looking worse abroad, and there's an expectation that we're going to see more economic weakness going into year end, and it's hard to be optimistic on equities, end quote. The Bank of England delivered a bigger half-point raise earlier in the day, joining the Federal Reserve and other central banks in the accelerated race to catch inflation, but the hike was widely expected, and investors were more focused on the central bank's warning that a lengthy recession is on the way. Quote, the main surprise seems to be the somewhat downbeat economic forecasts that we have also been given, said Stuart Cole, head of macroeconomics at Equity Capital. Quote, this is somewhat worse than we had seen in May, where the outlook for one or two difficult quarters of low or negative growth and then a recovery, end quote. Britain's FTSE 100 stock index was little change compared to small gains for the pan-European stock 600 index following solid corporate earnings. The euro added 0.53% to 0.84 against the British pound and rose as high as 0.8438 at one point for the first time since July 26th. Sterling recovered, though, to be up 0.08% at $1.21.59 after earlier dropping to $1.20.65 for the first time since July 29th. The greenback accelerated declines amid lower U.S. yields, with the dollar index, which measures the currencies against six major counterparts, including the sterling, the euro, and the yen, sliding 0.64% to 105.80. The dollar dropped 0.51% to 133.17 yen, with the currency pair particularly sensitive to long-term Treasury yields. Spot gold jumped 1.52% to a one-month high of $17.92 an ounce, helped by lower U.S. yields and a weaker dollar. So I think the dollar may have peaked at this point, and with the other currencies around the world also doing their version of QE and rate tightening, I think they're all just going to fall in unison. And I think long term, the dollar, whether or not it survives the next decade, I don't have a lot of confidence in it. The people running the Fed and the people running the government or administration are village idiots, and it seems to me they're on a suicide mission to try and destroy the country. But maybe that's just my libertarian views on things. All right, let's read up on the job report. U.S. weekly jobless claims increase, but labor market remains tight. The number of Americans filing new claims for unemployment benefits increased last week, suggesting some softening in the labor market, though overall conditions remain tight. That was underscored by other data on Thursday showing a sharp decline in layoffs announced by U.S.-based companies in July. Still low level of unemployment claims and brisk pace of hiring supports views that the economy is not in recession despite gross domestic product contracting in the first half. Well, again, the most simple definition of recession is 2 consecutive negative quarters. Again, if the people in the administration want to quibble over, whether or not it's a recession yet, or, because the job market is strong and the economy still seems fairly okay, it's not a true recession, but, it meets the definition. We'll see if we come out of this by the end of the year. I'll say, hey, I was wrong. Evidently it wasn't a recession, but, again, I've been through this. I've been doing this a decade and a half, and the writing appears to be on the wall at this point. All right, where were we? Quote, the risk is that claims continue to drift higher as labor market conditions slowly cool, but we don't anticipate a sharp rise from current levels anytime soon as demand for workers continues to outstrip supply, said Lydia Balsour, lead U.S. economist at Oxford Economics in New York. Initial claims for state unemployment benefits rose 6,000 to a seasonally adjusted 260,000 for the week ending July 30th, the Labor Department said. Economists polled by Reuters had forecast 259,000 applications for last week, so they're off by 1,000. Some of the recent increase in claims could be a result of difficulties adjusting to data for seasonal fluctuations. Motor vehicle manufacturers normally shut down assembly plants for annual retooling in July, resulting in temporary layoffs. But chip shortages could have disrupted the timing of retooling, potentially throwing off the model that the government uses to strip seasonal fluctuations from the data. Unadjusted claims fell 98.25 to 205,587 last week. A big jump in filings in Connecticut was offset by notable decreases in Massachusetts, Kentucky, and Ohio. Seasonally adjusted claims broke above 230,000 at the beginning of June, hitting an 8-month high of 261,000 mid-July. However, they remain below the 270,000 to 300,000 range that economists say would signal a slowdown in the labor market. Quote, if initial claims start to hover around that level, it would be cause for concern since it would increase the risk that unemployment starts declining and the unemployment rate begins to rise, said Ryan Sweet, senior economist at Moody's Analytics in Pennsylvania. Quote, a rising unemployment rate sends an ominous warning of recession, end quote. The number of people receiving benefits after an initial week of aid increased 48,000 to 1.416 million during the week that ended July 23rd. The so-called continuing claims, a proxy for hiring, were the highest in 3 months. All right, let's see here. The economy contracted 1.3% in the first half, meeting the definition of a recession. Wild swings in inventories and the trade deficit tied to snarled global supply chains have been largely to blame for 2 straight quarterly declines in GDP. There were 10.7 million job openings at the end of June, with 1.8 openings for every unemployed worker. For now, layoffs remain very low. A separate report from the global outplacement firm Challenger, Gray & Christmas on Thursday showed job cuts announced by U.S.-based companies dropped 20.6% to 25,810 in July. So that's some good news. So far this year, employers have announced 159,021 layoffs, down 31.3% from the same period last year, and the lowest January through July since 1993. Job cuts this year have been concentrated in automotive, technology, and financial sectors. Semiconductor shortages have hampered the auto industry, while layoffs in technology and financial sector reflect cooling demand because of higher interest rates. The Federal Reserve last week raised its policy rate by another 0.75 percentage point. The U.S. Central Bank has now hiked that rate by 225 basis points since March. Quote, job cut levels are nowhere near where they were in 2001 and 2008 recessions right now, though they may be ticking up, said Andrew Challenger, Senior Vice President of Challenger, Gray & Christmas. If we're in a recession, we have yet to feel it in the labor market, end quote. The claims data has no bearing on July's employment report, which is scheduled to be released tomorrow. According to Reuters survey of economists, non-farm payrolls likely increased by 250,000 jobs last month after rising 372,000 in June. A third report from the Commerce Department on Thursday showed the trade deficit narrowed 6.2% to $79.6 billion in June as exports surged to a record high. Trade was the economy's only bright spot in the second quarter, adding 1.43 percentage points to the GDP after being a drag for 7 straight quarters. Quote, that provides a decent base for net exports to continue boosting GDP growth going into the third quarter, said Andrew Hunter, an economist at Capital Economics. Quote, but with the latest survey evidence suggesting that faltering global growth and the stronger dollar are set to hit export demand over the coming months, that support probably won't be sustained. So, I mean, the employment market still looks pretty good. There are still a lot of jobs out there for those who actually want to work. But for those who, don't, I guess you're happy with the unemployment benefits. All right. Last article here, just some helpful hints about savings. Here's exactly how much Americans have in savings at every age. And yikes, here's what they should have. No matter I think I read this similar article last year. It feels like they just are recycling the same thing over and over again. All right, so let's go ahead and read through this. No matter your age, savings is a necessity, but depending on your age, the amount of savings you will need changes according to life stages and overall financial landscape. One overarching rule of thumb is that you should, even in times of high inflation, have somewhere between 3 to 12 months of essential expenses somewhere safe, like high-yield savings accounts. but this depends on a lot of factors. According to data available from the Federal Reserve Board's survey of consumer finances, the median savings balance, not including retirement funds, of Americans under 35 is just $3,200, $3,240, which, while that jumps to $6,400 for those 55 to 64. You can see here, see the average under 35 is $11,200. The median is $3,240. 35 to 44 is $27,900. The median is $47,10. 45 to 54 is $48,200, and the median is $56,20. And 55 to 64 is $57,800 is the average, while the median is only $6,400. This data is the latest available from this source, but it's from 2019, and some sources put average savings even higher. Northwest Mutual's 2022 Planning and Progress study revealed that the average amount of personal savings, not including investments, was $62,086 in 2022. So I'm wondering how they came up with that number. While those numbers look high, remember this: many Americans simply don't have any savings at all. According to Bankrate data from January 2022, 56% of Americans would be unable to cover an unexpected $1,000 bill with savings. In other words, Americans are very much in general undersaved, even though those who do save are often saving enough. So how much should you have at every age? This answer isn't entirely straightforward because pros say it really depends upon your lifestyle, income, and whether or not you have a mortgage, car, dependents, and more. Quote, I tend to think the best measure of how much savings you should have factors in your expenses. This includes your family situation. Someone in their 20s without a spouse or kids who rent and ride public transportation probably has very different savings needs from someone in their 30s or 40s with 2 kids, a stay-at-home spouse, and 2 car payments and a mortgage, says Ted Rossman, senior industry analyst at Bankrate. For his part, Rossman recommends having 3 to 6 months of expenses for emergency savings. That's a very good idea. I recommend that to clients. You might be able to go on the low end of this number if you have a 2-income household, and on the higher end if you're a 1-income family supporting kids. Quote, also on the high end if you're a business owner or in a field which might take an especially long time to find a new job, says Rossman. Some pros like Susie Orman recommend even more. She says 8 to 12 months is better. Again, it really depends upon your spending and your source of income. It's also important for people to consider savings goals that may be separate from emergency savings. Someone who aspires to buy a house within the next year or 2 should consider opening a separate savings account for that home down payment. Money intended for a relatively near-term goal is like that probably shouldn't be invested in stocks given the volatility, says Rossman. But it can also be helpful to separate it from your emergency savings because it's for a separate purpose and because research shows that people are more successful at saving when they have a separate account with a separate name. One way to accelerate your savings, set up a direct deposit from each paycheck into a separate savings account, says Chanel Bessette, banking specialist at NerdWallet. Quote, it becomes much less tempting to spend money if it never hits your checking account. It's natural to change your spending habits as you earn more money, but lifestyle inflation can sneak up on you. So try to keep an eye on how your expenses change as you age, and course correct if you find yourself spending beyond your means, says Bissett. All right. So how should you think of your savings in your 20s? In your 20s, your financial priorities are much different than those in later generations. Quote, people in their 20s are just beginning their careers and earning entry-level income while tackling college debt. By making smart moves now, like spending wisely, automating savings, and strategically contributing to your 401k, you can enjoy the fruits of your labor today while securing a successful retirement in the future, says Gabe Krajcek, CEO of Kasana, a fintech company that provides community banks with financial products and services. How about in your 30s? You're likely more established in your career and earning more, which should make it easier to save. Quote, lifestyle creep and lifestyle changes can make a huge crack in your nest egg. Before making purchases, consider whether the spend aligns with your values and gets you closer or further from your long-term financial goals. It's important to find areas where you can save, such as cutting down on eating out or skipping a streaming service. You should also build an emergency fund, purchasing life insurance, and adding to your 401k and working with a financial advisor to ensure you're making wise investment decisions, says Krashek. How about in your 40s? You probably have more assets and should focus on diversifying your investment portfolio and looking for additional streams of income. If you've managed to lock in a mortgage at a low rate rather than making additional payments, consider investing those additional funds into a rental property or other potential passive revenue streams. But first, pay off debt and maintain an emergency fund, says Krashik. How about in your 50s? Continuing to increase your retirement savings and investigate long-term care insurance. This next chapter may be weighing more heavily on your mind, so evaluate your current trajectory and take steps to ensure that you're on the track you intended. Quote, use an online retirement calculator and continue to check with your financial advisor, especially with current economic turmoil, says Krashik. As you get into your 50s and 60s, closer to retirement, your non-investment savings needs may actually fall. Your kids may be grown and out of the house. Your mortgage and cars may be paid off, and your income should rise over time, says Rossman. In terms of things that might vary by age, certain major expenses and life goals will come on and off the list. Quote, young adults may be especially burdened paying down student loans, for instance, but once those are paid off, that could represent a savings opportunity, says Rossman. And in your 60s, if you're not comfortable with your financial picture, evaluate your income, investments, and spending habits so you can make changes. If you're feeling secure, you may be thinking about the legacy you'll be leaving. Start to plan with people and causes you care about, and ensure you're protecting your wealth with a solid estate plan, says Krashik. All right, so all good bits of advice. I would probably, just generically, 3 to 6 months is probably a good place to start. Go through, like we talked about yesterday, going through your monthly and yearly expenses, see what they average out to be. If you primarily want to just look at, your necessities, mortgage, electricity, food, insurance, things like that, and then cut out your discretionary spending, and then just focus on, your needs spending. Take that, multiply it by 3 or 6 months, and that should give you a good ballpark number to stash away in a savings account or a high yield savings or something that's maybe going to earn a little bit of interest, but isn't going to be at the whims of the volatility of the stock market, especially right now. Volatility is certainly not great at this moment. So, all right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. And I hope everyone has a fantastic evening. And I'll talk to you tomorrow for the weekly wrap up. Bye-bye.